As October started off, the stock market was looking pretty good, but the last few days, not so much. For us long-term dividend investors, it's time to start looking for some stocks at a discount. And today I have for you 5 great dividend stocks all selling at a discount very close to our 52-week low. And if you watch till the end, I'll give you a small taste of a 6th one. So if you're ready, let's jump into it. The first stock on the list is Microsoft, ticker symbol MSFT. And Microsoft develops and licenses consumer and enterprise software. They have 3 different business segments, which are productivity and business processes, intelligent cloud services, and personal computing. From the start of the year, Microsoft has fallen about 30%, and just within this last month, they have fallen 8.25%, bringing them to a current share price of $334.24. They are very close to their 52-week low of $232. They have a current market cap of $1.75 trillion and are trading at a current PE of 23.03. They have a current dividend yield of 1.16%, and that'll give you an annual payout of $2.72. Their current payout ratio is just under 27%, and they have a growth rate for the last 5 years of 9.71%, and have been growing that dividends consistently for the last 17 years. SCHW gives them a dividend safety score of A+ and a dividend growth score of A+ as well. And Dividend Tracker gives them a dividend safety score of 92. Over in their income statement, looking at the revenue, you can see that year over year they have been increasing their revenue from $110 billion to $198 billion. Scrolling down here, looking at their net income, along with their revenue, they have steadily been increasing their profit. So they had $16.57 billion to currently $72.74 billion. Scrolling down once again, to look at their earnings per share, they have been increasing their earnings per share consistently. They had $2.14 5 years ago and currently have $9.70, so great sign there. Now we want to look at their shares outstanding because we don't want a company to be diluting their shareholders by issuing shares. And Microsoft is doing great by their shareholders and have been buying back shares. So they had 7.68 billion shares and currently have 7.47 billion shares. So they're definitely buying back shares. And looking at their dividend growth, they have steadily been growing their dividend year over year. So that's a great sign as well. Over on their cash flow, we're going to scroll in here to their free cash flow. And how you calculate free cash flow is your cash from operations, this line right here, subtract your capital expenditures, this line right here, and I'll give you your free cash flow. And the 5 things you can do with free cash flow and why they're important is it allows the company to pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back in the company. So looking here, we can see that Microsoft has definitely continued to increase their free cash flow year over year, which is a great sign, and that brings it to a 5-year average of $47.4 billion. Now over on their balance sheet, first we're going to look at their current ratio, which is their current assets divided by their current liabilities. And we want that value to be greater than 1.2, which means that they have healthy financials, having more assets than liabilities. So right here, you can see that they have $169 billion in assets, and scrolling down here, current liabilities is $95 billion. So taking the difference there, we have a ratio of 1.79%, which is great for Microsoft. And scroll down right here once more, we're going to take a look at their long-term liabilities, which is $103 billion, and we're going to divide it by the 5-year average of the free cash flow just to see how many years to pay off all of their debt. And taking that calculation will give them just over 2 years to pay off all of their debt if they chose to do so. So that's good for Microsoft as well. Now moving over to what Wall Street analysts are viewing as a fair price target. And their low price target is $252, which is just above 8% of what its current value is. And their average share price value is $337, which is a 44% upside. Scrolling down again, we're going to see what analysts see as a revenue forecast. And for the next 3 years, they are looking at about a 14% increase in revenue. And look right here at more analyst estimates, more data, never hurt anybody. We have about 6 years right here. Taking those 2 in consideration, I'm going to have my revenue growth assumptions from 8, 10, and 12%, just to stay on the conservative side. For my profit margin and free cash flow margin, I'm going to take a spread of 26 to 30%. For my PE value and my price to free cash flow, I'm going to do 16, 18, and 20%, and then have a 10% return rate. Right in here, analyzing my assumptions, and the current value is in between my mid and high assumptions. So I definitely see this right now as being a fair value, coming into that low 200 range where it's been lately close to 300. So definitely think is a fair value. I want to take a minute to look at a chart analysis just to see where the current share price is compared to history wise. And right here, we're looking at a weekly view. We can see that the current share price moving back in March of 2021 was a support, and they broke through it. And previously it was a resistance point around that 230, 225 range. So looking down here, the current trend is in a negative. So there's a good possibility we could stay at this support level or possibly break through because the trend is still in a negative trend. So I do still think this is a good area to pick up some shares and possibly write it down as the stock either stays around at 230 or possibly goes down. Next stock on the list is Apple, ticker symbol AAPL. Apple designs a wide variety of consumer electronics from iPhones, iPads, Macs, Apple Watches, and so on and so forth. From the start of the year, Apple has fallen 23%, and just within the last month, they have fallen close to 10%, bringing them to a current share price of $140.09. They're trading close to their 52-week low, which was $129, and they have a current market cap of $2.25 trillion and are trading at a PE of 22.94. Apple currently has a nice cute dividend yield of 0.66%, and they'll give you annually 92 cents. They have a payout ratio of 14.69% and have been growing that dividend for the last 5 years at a rate of 8.45% and have steadily grown that dividend for the last 8 years. Seeking Alpha gives Apple dividend safety score of A and a dividend growth score of A+, and a dividend tracker gives them a score of 89. Over on their income statement, we can see that Apple has steadily been increasing their revenue year over year, which is a great sign. Scroll down here to their net income, we can see that along with their revenue, they have also been increasing their profit year over year, which is really great. Very close to doubling what their 5-year total was, from 56 billion to right now 99 billion. Scrolling in here for their earnings per share, they have grown their earnings year over year as well. And looking at their shares outstanding, we see that they have steadily been buying back their shares, which is really great, from 19.53 billion shares to 16.16 billion shares. So great job, Apple. And they have been increasing their dividend year over year. Small increases year over year, but still increasing their dividend. Over on their cash flow, just scrolling here, looking at their free cash flow, and they have been steadily increasing their cash flow year over year, which is great to see as well. And now we have a 5-year average of $78.36 billion. So looking at their current assets, we have $112 billion. And scrolling down here, current liabilities, we have $129 billion. So taking a ratio, we have just about 0.86%. So underneath that 1% that we're looking for. Taking a look at their long-term liabilities, we have $148 billion, and dividing that by their 5-year average of $76 billion, we have just under 2 years to pay off all of their long-term liabilities. For Wall Street analysts, they have a low price target of $123, so that's about 12% lower than the current share price, and they have a medium of $185, about 32 upside from the current share price. Revenue forecast is about 6%. And looking at some more estimate right down here. So for my assumptions, my revenue growth I'm taking from 2, 4, and 6%. For my profit margin and free cash flow margin, I'm sticking with the historical value. So going from like 16, 19, and 23, and 17, 21, and 25. And then for the PE and price to free cash flow, going from 16, 18, and 20, just like with Microsoft, and a 10% return rate. So calculating all these assumptions, a high assumption of $130 for my discounted cash flow and $120 for a multiple of earnings. So I do think that Apple is moving close to this range. So as it gets into that 130 range, I definitely see Apple as being a fair value right now. And taking a look at their chart here, we can see that their current share price was pretty much a support back in June, and they bounced off of that. Previously, it was a resistance point back in February and April of 2021. And look down here, we can see that Apple is still in a negative trend. So very well that they might stay at that support level of the 140, 130, or possibly break through it and fall to the 125, 116 area. Coming to stock number 3, we have Home Depot, ticker symbol HD. Home Depot is the world's largest home improvement specialty retailer, and they range from building materials to home improvement products, lawn and garden, and also decor products, among various other services. For the start of the year, Home Depot has fallen 30.42%. Just within this last month, they have fallen 2.5%, bringing the current share price of $284.32. They're trading closer to their 52-week low, which was $264, and have a market cap of $291 billion, and are trading at a PE of 17.14. Their current dividend yield is 2.67%, and they'll give you an annual payout of $7.60. Their current payout ratio is just above 45%, and for the last 5 years, they have grown that at a rate of 16.95%, and have steadily grown that dividend for the last 12 years. Seeking gives their dividend safety score of a D, and their dividend growth score of a C+, and a dividend tracker gives them a safety score of 88. Over on their income statement, looking at their revenue, we can see that they have been growing their revenue year over year. Scroll down here to their net income. We can also see that they have been growing their net income year over year. A little stag in 2020, which is understandable, but definitely have recovered from then. Scrolling down here again, looking at their earnings per share, you can see that they have been growing their earnings per share year over year. Pretty much stagnant from 2019, 2020, understandable. Looking down here for their shares outstanding, we can see that they have been buying out shares, which is great to see, from 1.14 billion shares to currently 1.02 billion shares. And their dividends year over year has steadily been increasing too, which is great to see. Over on the cash flow, scrolling down here, looking at their free cash flow, you see that they have been growing their free cash flow year over year with a spike up in 2020 with everyone doing their home improvement projects while being in the lockdown. But after that, pretty steady with the last years before. Now bringing to average 5-year average of $12.19 billion. Taking their current assets, we have $23.94 billion, and scroll down here to their current liabilities, you see $29.83 billion. So I'll give you a ratio of just about 118%. And right on here on their total long-term liabilities, we have $47.74 billion, and dividing that by their 5-year average of $12 billion, we get just under 4 years of being able to pay off all their liabilities. And Wall Street analysts see a low price target of $284, which is pretty much right in line with what we're sitting at right now, and an average of $362, which is about 27 upside. And as far as revenue growth, they are predicting about 4% in the next 3 years. And looking at some more estimates for you. So taking those assumptions into consideration, I'm going from 1%, 3%, and 5% for their revenue growth. For their profit margin and free cash flow margin, going from 5.79% and 5.79% as well. And their PE value and price to free cash flow going from 14, 16, and 18 for both of them with a 10% return rate. Looking at these assumptions right here, we see that my high assumption is 260, so we are above that right now. I think that Home Depot is moving into the right direction. The price is coming down. Being under that $260 price range is what I'm looking to right now. Over in the charts, we can see that previously back in June, 270 range was a support level for them. We can see that earlier this month they did bounce right off of that, and this white line is a 200-day moving average. Possibly they could bounce, but right here the purple line is a 25-day moving average, so they could be kind of stuck in there. We can see right here that they kind of broke through the 25 moving average, but then came right back down. So they are still in a negative trend right now on the weekly view. Kind of looking historically, we do see that this around that 285 level was a resistance point. So very well, this could be a support level for them. So they could be kind of right in that 275, 280 for a while. And if they do break through there, they might just make it down to that 260 level that I'm looking for right now. And just want to take a look at Lowe's to see how compared with Home Depot. We can see that where Lowe's is right now was a previous support. So very much like Home Depot, Lowe's could be staying at the support level and possibly bouncing up. We could see that the purple line is the 25-day moving average and the green is the 100-day moving average. So we are still in a negative trend just like with Home Depot, and possibly come back down or kind of right out that support level. If you've been enjoying the content so far, let me know by smashing the like button. It helps grow the channel. And also drop a comment down below if you have any of these stocks I'm going over today in your current portfolio or on your watch list. Next on the list is MasterCard, ticker symbol MA, and they're the second largest payment processor in the world, and they operate within 200 countries. From the start of the year, MasterCard has fallen 20 0.48%, and this last month they have fallen 9%, bringing them to a current share price of $294.97. They're currently trading very close to their 52-week low, which was $281. They have a current market cap of $285 billion, and are trading at a PE of 27.91. Just like Apple, MasterCard has a very cute dividend yield of 0.66%. That'll give you an annual payout of $1.96. They have a payout ratio of 19% and have been growing that dividend at a rate of 17.37% for the last 5 years, and have steadily been growing that dividend for the last 11 years. Seeking Alpha gives MasterCard a dividend safety score of A+, and a dividend growth score of A+. And the dividend tracker gives them a dividend safety score of 80. Over in the income statement, looking at its revenue, we can see that they have been growing their revenue steadily. Pretty much the same in 2021 and 2020, but they have been bounced out of that to current $20.87 billion. Scroll down here to their net income. We can see here, just like their revenue, 2020 and 2021, pretty much around the same profit, and they have bounced out of that to current profit of $9.7 billion. Now looking at their earnings per share, we can see that they have steadily been growing their earnings per share for the last 5 years and pretty much kept it the same, just like their revenue and profit in 2020 and 2021. Pretty much the same right there, a little drop. As far as their shares outstanding, we can see that they have been buying back their shares. So they were in 1.04 billion shares, and currently they have 971 million shares. And their dividend has steadily been growing year over year, as you can see right here. On their cash flow, scrolling down here, looking at their free cash flow, you can see right here, it was growing steadily year over year, except in 2021 it dropped, which makes sense looking at their revenue and their profit pretty much stagnant from 2020 and 2021. It would make sense that their free cash flow did drop as well. However, they did pretty much rebound from it, so they have $9 billion this year. And I'll bring to a 5-year average of $7.09 billion. To calculate their current ratio, we're going to look at their current assets, which is $15.21 billion, and scroll down here to their current liabilities of $12.09 billion. So taking the difference of the two will come to a ratio of 1.26%. So that's above our 1.2% that we're kind of looking for a healthy margin. Once more, scrolling down here to their long-term liabilities, and we have $17.88 billion, and dividing that by their 5-year average of $7 billion, we get about 2.5 years for them to pay off all their liabilities. As far as Wall Street analysts, we're looking at a low price target for $378, which is about 29% upside, and an average of 433. For their revenue forecast, analysts are looking at 18%. And we're at here, just some more data for you guys. So taking those estimates into consideration, I'm looking at a 12, 14 to 16 as far as my revenue growth. As far as the profit margin and free cash flow margin, I'm going from 34, 38, and 42. For PE and price to free cash flow, going from 14, 16, and 18 with a 10% return rate. Now bring me to a high assumption of just under $400 with a medium just under $300. So right now, I do think that MasterCard is trading at a fair value, and it is getting closer to their 52-week low. So definitely a good time to pick up this stock. Also, taking a look at their chart here, we can see that what they're trading at right now was pretty much a support back in October of 2020 and June of 2020. So they haven't been this low in a few years. So if they break through this, their next support is around 270 to 260. So they are still in a negative trend, as we can see right here. And it looks like, based on the last 2 weeks, they might be staying on the support for a while, because they did bounce off it right there. So if they do bounce off, they might come to a resistance point of their 200-day moving average. So definitely want to keep an eye on it. But as far as having it drop this far, is a good time to pick it up at a discount. Moving on to our next stock is Charles Schwab, ticker symbol SCHW. And Charles Schwab operates in brokerage, banker, and asset management businesses. They also have an investing website along with an app. Let me know down in the comments if you use Charles Schwab for investing in your dividend stocks. Personally, I use M1 Finance along with Webull. For the start of the year, Charles Schwab has fallen 13.35%. And within this last month, they have grown just under 6%, which is great for Charles Schwab. You can see here they had a nice spike up at the beginning of October, and now bringing it to a current share price of $74.31. Unlike all the other stocks we've looked at today, they are trading more at their mid-range, so not too close to their 52-week low. And their 52-week low was $59.35 with a high of $96. Market cap of $139.6 billion and are trading at a PE of 18.92. Charles Schwab has a dividend yield of 1.18%. And now give you an annual payout of 88 cents. They have a payout ratio of 22.09% and have a 5-year dividend growth rate of 20.88%. And they have been growing their dividend for the last 0 years consistently. However, looking here, they have consistently paid their dividend for the last 32 years, which is great to see. And Seeking Alpha gives them a dividend safety score of A- and a dividend growth score of B-. The dividend tracker gives them a safety score of 65. Over on their income statement, looking at their revenue, we can see that year over year they have been increasing their revenue. And just like MasterCard, pretty stagnant in this 2019-2020. Scroll down here to their net income, we can see that they have been steadily increasing their profit year over year, and they were pretty stagnant, a little drop there in 2020. Earnings per share, they have been growing their earnings per share as well, with a slight drop there in 2020. And they have been able to rebound off of that to get $3. For shares outstanding, we can see that they have slightly increased their shares outstanding. And the reason for that is to make an acquisition back in mid-2020 to acquire TD Ameritrade. So that explains this spike up of shares from 129 billion to currently 1.9 billion shares. And looking at their dividend, they have steadily been increasing their dividend year over year. Over on their cash flow, scrolling on here to their free cash flow. In 2019 did have a jump up in free cash flow, and then right down here in 2020 they dropped back down, but that is when they made their acquisition of TD Ameritrade, and they were able to pretty much bounce back, so they were close to their previous free cash flow, and right now they're back down. So I'll bring to a 5-year average of $4.4 billion. Now, since Charles Schwab is a financial institution, their balance sheet looks a little different, so we don't have the current assets and current liabilities like we did have in the other stocks that we looked at. As far as analysts are concerned right now, low price ticker is $73, which is pretty much where we're at right now, and an average of $89.76. Analysts are predicting a revenue increase of about 10% in the next 3 years, and here are some more analysts' assumption. So for me, for my revenue growth, I'm keeping a spread of 5%, 7.5%, and 10%. And then for my profit margin and free cash flow margin, going from 23, 26, 29, and 24, 27, 30. And then for our PE and price to free cash flow, keeping that at 14, 16, 18 with a 10% return. So looking at here, based on my assumptions, right in between my mid and my high assumption. So high here is going to be around 81. And then mid is going to be around 57. So I'm going to pay more attention to price of earnings since it is a financial institution. The free cash flow is a little different than in other stocks we've looked at. So as far as this, I think that Charles Schwab is currently on a downward trend. I'm thinking it's moving into that fair price range. And speaking of the trend, looking here at the charts here, we can see that around that $70 has been pretty much the support for the last few weeks. And they're pretty much riding on their 100-day moving average and on their 50-day moving average. And back in July and September of 2021, that $70 was around a support. So they have gotten a low of around $60. So if they do break through these moving averages, possibly we could fall back to the $60 range. And you can see right here, the trend is turning over. So possibly we are going to be entering a negative trend right here. So definitely keep an eye on that. We could be riding these moving averages for a while and possibly turning over to this $60 range. Bonus stock I want to share with you guys today is Broadcom, ticker symbol AVGO. Since the beginning of the year, Broadcom has fallen 30.58%, and this last month has fallen 8%. So that brings them to a current value of $460.48. So they are very close to their 52-week low, which was $443, and they are moving in a negative trend right now. If you'd like to see my full analysis of Broadcom, definitely consider subscribing to the channel. And I'm Ed V, and I'll catch you in the next video right over here.